Right now, with the surging stock market here at the time I'm recording this in the past few years, is there a reason to be playing defense in your portfolio at all? And if so, how? How should you be playing defense? I've got 3 reasons why it's important and 3 effective ways to be playing defense in your portfolio. I got that more coming up. Legendary investor Howard Marks has said that one of the biggest financial decisions every investor needs to make is how much offense and how much defense they play within their portfolio at all times. I was just listening to a very well-known money manager, and he was sharing that at the beginning of the year, he had a lot of hedges in his portfolio and was very cautious about the concerns with AI and where the market was and valuations. And by the end of January, all of their hedges were gone and they've been long and very, very aggressive, calling this the Goldilocks situation, and that you really shouldn't have any defense going on. It should all be offense and you should be taking a lot of risk. I personally don't feel that way. I would always want to make sure, going back to Howard Marks, that you are very aware where should you be playing offense and where should you be playing defense. And I think there's really 3 key reasons from what we can see. There's always stuff that's happening that might surprise us, but 3 very clear reasons why it's important to be playing some defense in your portfolio, depending on what stage of life you're in and what your investing goals are. But number 1 is overall AI, right? And uncertainty around AI. You're probably sick of hearing about this, and yet we know that AI is a significant force, and no one yet truly knows exactly how that force is going to play itself out. Is it going to be very disruptive to the labor markets? Is it going to be opportunistic and create a lot of productivity? I personally think that. And yet we also don't know. I heard a take recently that, AI, it's very possible, could turn into a utility where pretty much everyone has access to it. And it's very usable in their everyday life. And yet, from a business standpoint, the companies that offer it don't actually create a lot of profit. And so we really don't know. We don't know just yet. And so is AI going to create this big economic windfall or this big economic opportunity? Or is it a lot of speculation and actually not going to create a lot of market value? Well, what's happening right now? Take a look at the S&P 500 and the concentration of the S&P 500, just of the top few holdings. The top 10 companies right now. So you got your Mag 7, but then plus a couple of others. So your top 10 companies are currently making up 41% of the entire S&P 500. And if you say, how is that possible? S&P 500, that's 500 companies. How can 10 equal almost half of the S&P 500? Because it's market cap weighted, meaning not every company gets 1/500th of a representation. It is, well, how valuable is the company? So Apple and Google and Nvidia, they're bigger companies, and therefore they're going to take up a larger kind of weighting. And so top 10 equal 41%. That's near record highs. Let me ask you this. How many of the top 10 are really connected and heavily connected to what's happening in AI? All of them, right? I mean, and these are the big players other than Anthropic and ChatGPT or OpenAI, which are not publicly traded yet. But those obviously are very directly, but so is Google, and so is Microsoft, and so is Meta, Facebook. These companies are very, very connected to AI. And I'm not suggesting, well, guys, we're in an AI bubble. I am saying that the optimism around AI is pushing markets in a certain way, and I get that. And yet, if we get sort of expansion and contraction, optimism and then pessimism with AI as we figure out, well, what's it going to do to the economy? These companies, which take up the lion's share of the weighting, likely could get pushed around as well. And those swings could be very violent. If you look at Tesla or you look at Amazon, I mean, if you look at some of the drawdowns, got a video upcoming about those, because we all look back right now and say, oh, I wish I would have bought Amazon or Nvidia at these early times. Wait till you see the drawdowns that those companies have experienced. 60, 70, 80% drawdowns that, yes, now we're on the other side of that, but no one knows whether we're going to see another one of those again. So just AI uncertainty, to me, that is the biggest reason. Even if you're very optimistic about where things can go and the potential, AI uncertainty is one major reason to play defense. If you don't have defense and we start seeing those violent swings coming out of the blue, will you have the fortitude to just ride through it? or do you need some defense? That's one. And then the couple other obvious ones is we've obviously got the global conflict going on right now, and that could expand. We don't know exactly where that's going. You could already say that it's taken on a whole different life than anyone sort of expected. And so that frustration, that concern is one. And then we're still in this K-shaped economy. And that's a phrase of saying that as we are emerging through this economy, those that have slightly higher incomes and slightly higher net worth, they seem to be doing just fine. Those with lesser income or lesser net worth are struggling to keep up. Guys, what that means is we've got a shrinking middle class, and economies that thrive have a thriving middle class. I think this is an enormous threat and could pose a long-term challenge, and certainly is a reason to be playing some defense, because if we don't have a strong middle class, it's going to be difficult to say no, the economy is going to continue to thrive and move along without a clip. If any of those reasons resonate with you, or maybe you've got some others, I'd love to hear them down below. But yes, now is the time to be playing some defense depending on where you're at. As you're approaching retirement, absolutely. As you're in retirement, absolutely. If you're at the beginning of your career, no, I wouldn't. I would just stick with diversification. But here's the problem with relying on diversification as your main source of investment defense. When you need it to show up, you don't know if it will. I mean, and that's not a knock on diversification. That is how it works. Does it work? Yes. Will you like it? No. That is how diversification works, is when you need it to show up, everything's going down, or there's some big concerns. Is diversification going to help you? Many times it falls short. Okay. So what are 3 ways that you can be playing defense in addition or instead of diversification? Number 1, guys, and this is the number 1 way, and I mentioned it in the intro, hedging. Average investors, normal investors, those you and I, long-term investors, we should be using hedging. I would argue maybe even more than you should be using bonds, or instead of bonds, you got to work with the CFP that knows your financial goals, knows your risk tolerance, knows your investment situation, and is independent. And they can assess, well, should hedging play a role and what would it look like? There's a lot of different ways to hedge. You can buy individual stock options. You can do different stock option strategies. You can buy a lot of exchange traded funds or mutual funds that offer some hedging in it as well. Not all of these are the same. You want to make sure that you understand the mechanics and how they work. A lot of them that are fund related, they're in the what's called the buffer space, where you are going to participate in the overall stock market up to a certain cap, and then you will have sheltered a certain of the downside away. Not all of these are the same. They're at very different cost structures, have very different participation. You want to make sure that your certified financial planner understands your goals, your needs, your financial situation, and then understands that market so they can navigate that with you to ensure that you've got the right hedging as well as the right percentage. How much of your portfolio should be hedged away? This used to just be on large cap stocks. Should you be using other tools as well? So hedging is, to me, the number 1 way that you'd want to play defense. Why? Because where diversification falls short, I need some downside protection. Is diversification going to help me? I don't know. With hedging, I need some downside protection. Is hedging going to help me? Yes, it will. It will. It's like your homeowner's insurance premium, okay? Where, I hope my house, I don't have a big loss. But if I do, I've been paying this homeowner's insurance premium. I know my insurance will be there to help out. My second way of recommending that you're playing defense right now, and this one is not for everyone either, but this is where you've got equity income. And there are some really sophisticated tools that are now on the market and available to you. So again, I would be working with your CFP to, yes, make sure that they understand your goals, all 6 areas of your financial life and what you're investing for, and then consider whether a portion of your portfolio should be in both equity and income. So why is this a defensive play? Because whether the stock market's surging or whether we see some of these risks scare the market, spook the market, and the market goes risk off, you're still getting that income. And you might say equity income, the yield on the S&P 500 is near historic lows. It's like 2%, less than that. And so you might say, why would I? That's not a lot of protection. The market can move 2% in a day. I know there are more advanced tools out there right now that are paying 3-4%, some in the 7, 8, 10, 12%. These get very interesting and get very complicated. So they're not for the faint of heart. Again, work with your certified financial planner. But that equity income sort of strategy and having a portion of your portfolio there, again, can help offer some defense that shows up even if, the normal diversification doesn't help. And the third way to be playing some defense right now, above and beyond normal diversification, and I know when I preface this, I said, I maybe doing this instead of bonds. Bond funds or bond exchange traded funds have their place, but I wonder a third way to be playing some defense is maybe owning some individual bonds. Maybe now is a time to be more selective. If you want to have, again, diversification, where, all right, if markets start getting jittery and I need to be playing some defense, what areas of my portfolio are playing defense? If you've got bond funds, exchange traded funds, mutual funds, we don't know. You don't know if they're going to be playing defense. But if you own individual bonds that are paying a certain interest rate and you know exactly when they're going to mature and you're optimizing for those things, yeah, even if the value of that bond changes in the short term, you know the experience of that bond, and therefore that can be a great way to be playing defense. So my question to you is, how are you playing defense in your portfolio? And what we didn't talk about is, do you know how you're playing offense in your portfolio as well? Guys, these are critically important in order for you to have the right investing approach, the investing philosophy, and that investing structure to help you reach and achieve your financial goals despite what happens in the roller coaster along the way. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.